Hello, everyone, and thank you all for being here. And it's a great attendance again, as always. Um, I came here last year and I was talking about that we were in a new energy super cycle and that this was the third one of my career. And it was April of 2020 that it started. And we had the price of oil, as you heard of this earlier from Victor, that it went to negative pricing in the futures market. And it was 650 on the April contract. And we ended up having a fabulous run in the sector. And many of the stocks, shockingly, in the next year or two, 2022, 2023, went up over 10 times. But always in these cycles, you're going to have corrections. And we talked last year about a correction. And I mentioned that I thought in March we were going to probably see another buy signal. And we ended up getting two buy signals in March of 2023. And we ended up from 8 stocks only on our buy list. We added 7 on one of those days and 7 on another. So we ended up with 22 names on our buy list. And then there was a fabulous run on the price of oil to $90. And then we said, hold off, guys. We're a bit overbought. Watch the market. It's going to probably cool off. And we did get the pullback below $70 a barrel in December. And we sent out another buy list of 7 ideas in December 7th of last year. So today we're looking at the price of oil at 72 bucks again. It was 78 bucks on Monday. And everybody says, what's going on with the price? Why is it moving around so much? Well, we had $10 a barrel of war premium in it because of what's going on in the Middle East. First, of course, it was the issue of Gaza and Hamas and Israel. Then it became the issue of the Houthis with Yemen and what's going on in the Red Sea and the Gulf of Aden. And we had that war premium come back. But now the war premium is dissipating because on Monday they were thinking, oh, Biden's going to attack Iran. And now he's made the decision, no, we're going to just keep it to Syria and Iraq. But the fundamentals of oil and gas are right now in surplus. So we've been saying to the clients and people who are subscribers that we think the price of oil is going down one more time below 70, potentially to 65 to 68 over the next little while, maybe the next 2, 3, 4 weeks. And we expect to see another buy signal. That buy signal, though, is going to be one of those key buy signals that you get. And I'll show you, as I go through this presentation, how you get those. And that's when you want to get to a fully invested position. Since 2020, I have not said that. Normally, I've said the market's going to get ahead of itself, hold off, let your dividend income come in, gather up some cash, wait for the next buy window. We'll add some more names. And that's what we've done. And it's worked out very, very well. So we're very fortunate that 9 of the companies that we cover are here today. And so they spoke, 6 of them spoke this afternoon. And 3 of them will speak tomorrow morning at the VIP and breakfast. And I think that you should go and spend time with these companies. I'm going to show you how cheap they are. I'm going to talk about the companies in my presentation. But you need to go for your own comfort so that you understand how cheap these things are and how much upside they have during a super cycle, and go there so that you can learn about them and decide which ones fit your portfolio. Now, we cover pipelines and infrastructure stocks. Those stocks are going to do okay, but they're going to give you 7-8% dividend yield, 2 to 3% growth in the dividends, and they're going to give you 5-10% capital gain if you buy them right. But where the sexy side is, where the capital gain potential is going to be in the E&P side, domestic and international, and in the service sector. And that's what I'm going to talk about as we go through the presentation. So we are in that new energy super cycle. And that one started in March of 2020, and I expect it to go till the end of this decade. The other 2 cycles, and I'll show you a chart soon, were 1974 to 1981. And then the other one was 2000 to 2008. And there's always a catalyst for it where there's a new entrant, there's a new buyer of energy that drives the change from an underinvested, balanced market to, oops, there's a new buyer in town and the price takes off. And I'll go through that as we do that. So we've had $90 earlier in 2023. I think we're going to see $90 again in Q4 of 2024. And I think we're going to see north of $100 next year and higher than that as we go through the end of the decade, because the industry is not spending enough to bring on new production sufficiently. And the big thing is the growth in energy demand is not coming from the OECD. It's coming from the emerging world. Where are we going to get the copper, the nickel, the lithium, all the things we're going to need to get to that renewable transferred world? That's going to have to come from Asia, from Africa, from South America. And they're going to want the same things as we do. They're going to want heat. They're going to want the electricity in this. They're going to want cars. That's where the energy consumption is going to happen. Now, the commodity cycle had that fabulous run in 2020 to 21, 22. We've had a pullback here, but we're already seeing signs of the next phase of it coming. Uranium has doubled and Cameco has doubled. If you look at cocoa and coffee, the prices have already taken off. If you look at rice in Asia, it's taken off. The gold price has moved up, and I think it broke to new highs this year. So we think that there's a lot of upside in this whole super cycle, and it's still very, very early, and we're just in one of those pauses, and that pause is very close to ending. So what is a new energy super cycle? One is the lack of capital investment in the sector. Two, it's the fossil fuel demand from, as we mentioned, lithium, copper, uranium, all those countries that are non-OECD. The industry is not spending money like crazy. Who's spending the money? Government. We heard that a few minutes ago. Just think about the fourth quarter GDP. They said it was up 3.3%. So the GDP in numerical was up $329 billion. But do you know how much the government had to borrow? They had to borrow $834 billion to create that 329 billion of growth. That means they borrowed $2.50 to create $1 of GDP. Isn't that nuts? It's absolutely nuts. So let's keep on going. At market peaks, companies in the energy space in 1980, in 2008, were trading at 8 times cash flow. Today, they're trading at 2 and 3 times cash flow. Go talk to the companies that are out there. Go spend the time with them in their booths, and then say to them, okay, at $75, what are you going to do? Or at $2 gas, what are you going to do? What are you going to do if at $100 oil? What are you going to do at $5 gas? Ask them based on today's production, and then say, well, if that happens, your production's probably going to go up. What's that going to do to your valuation? So I'll be talking about that as I go through this. And OPEC can't raise production materially. Saudi Arabia said, oh, we can have capacity of 12 billion barrels a day, 12 billion barrels. We're going to go to 14. Now they're saying they're going to 12. And the problem is we haven't seen them being able to produce even at the 10 sustainably. So we think before this is over, we're going to see $125 at a regular basis into that 27 to 29 time period. We think natural gas, because of the LNG market, that's, Biden is saying, oh, we're going to halt it, but there's still a lot of projects going forward, and I'll show you that. And we're going to see the Canadian side have 6 to 7 BCF of takeaway capacity before the end of the decade. Remember, 6 to 7 BCF on 17, 18 BCF is a pretty good growth rate. And that's going to help the Canadian natural gas industry going forward. The TSX Energy Index, we expect to double during this cycle. So going there. This is an interesting chart. It shows the S&P commodity index versus the S&P 500. And if you look there, the oil crisis, again, look at this, oil crisis, Gulf War, financial crisis, and then 27, 29, it could be the debt crisis, it could be another war, it could be whatever. You're hearing war cycle talk, you're having a number of issues here, but we're looking at a number of choke points that are important for the movement and traffic of seaborne. One of them, of course, is the Red Sea, which we know about now and all the problems, and that's going to cause shipping costs to go up, and that's going to affect the deliveries and all that, and that's going to be inflationary. You've got the Strait of Hormuz, which is, of course, the between Iran and Saudi Arabia, and the small area of traffic to get through there. And then the one that's probably the most important is the Strait of Malacca, because the Strait of Malacca is how you get product by ship to India and China. And if any of those has any disruption by pirates, by by Houthis or any of the other terrorist groups, that is going to have a major impact. And I think the Middle East is just one place where there's a powder keg. There's also Asian powder kegs, and I think we need to be very careful and watching that. This is a very interesting chart. It's the Goldman Sachs Commodity Index. And you can see there in 2008, the peak there on the left-hand side, and it was, you can look at the bottom, you see this, the full stochastics. You can see we got up to that high. The financial crisis, you had a very big decline. It went up afterwards. And then in the period of 2014 to 2016, we had the Saudi Arabia and Russia fight over market share, and the price of oil came down, and it's the biggest weight in the commodity index, so you can see how that got beat up. Then you go, of course, to the COVID situation and the decline that happened there. We had that nice run up after that in 2022, which I talked to you about how well the stocks did in the energy sector. Then we came down. But look at the bottom area. On the bottom area, we're looking at 2015, 2016. You can see that the absolute number went down lower. But if you look at the stochastics, the second low was higher than the first low. Now go to the right-hand side, and we have a new lower low on the index. And now you look at the bottom, we have a higher low on the technicals. And I drew that downtrend line so you can see that we're getting very, very close to breaking out. And remember, energy is a big component. And if we get to $90 oil, we broke it out. You have copper join the party, we break out. You have a number of indices, commodities that help out here. And the reason is this: 50% of the world lives in the emerging world. 3.7 billion people. They have a lower life expectancy. 25% of them live without electricity. If we're going to ask them to develop copper mines and lithium mines and nickel mines and all this other stuff and provide us with the raw materials, grain, whatever it is, we're going to need cocoa, my favorite, my chocolate bar is going to cost more. All of that has to come, and they have to have a reasonable lifestyle for them to do it. So the OECD is where we're going to see the demand for fossil fuels. They're going to need, they're going to need diesel, they're going to need gasoline. While in the OECD, we're going to probably consume less. So if you look at rising energy demand, even coal is going to do well because China and India keep on building more coal mines. But the OECD probably will see a decline because of environmental rules, more EVs, we're going to change around. But we're going to see the China and India continue to grow rapidly in terms of consumption. And we're going to see Africa grow in consumption. Just look at all the things that we all consume. It has petroleum products in it. And so we're going to need petroleum products in our lifetimes, period. So let me just ask you now how people are invested in the energy sector. Here, raise your hands. How many of you own 2 or less names in the energy patch? A few. How many own 3 to 5 names? How many own 6 or more? Okay, you're my audience. We own 8. And we're probably going to take it on this, we get this next buy signal, we're probably going to take it up to 10 or 11 names and add some new names and add more to the names we already own. So here's the chart on, as I've shown you many times. The first cycle of 74 to 81 was Japan at the margin came in. We started buying Datsuns and Toyotas, and we started buying more Sonys, everything else. Their economy took off and they became a major new entrant buying. And that was the time of, many of you may remember names, Dome Petroleum, Hudson's Bay Oil and Gas. The sector did well. And that was when we were consuming 62 million barrels of oil. You can see there we got down to $10 in 1999. And then the new entrant at that time was China. They were producing 4 million barrels, consuming 3.5. And by the end of that period of time there, by 2008, they were consuming 11 or 12 million barrels. To date, at that time, 86 million barrels were being consumed, up from the 54 in the 70 cycle. And then we had 2008, the financial crisis, the price of oil came down. And then we started in March of 2020 on the right-hand side, third cycle. This is the emerging world that we need to come and bring all these up. And we're looking at demand now of 102 million barrels. So we're starting up again. So if you look at these cycles, this is the 99 to 08, kind of a go in, let's look at it. The cycle from the beginning, as you see in the top arrow, went up 13.6 times. If you look at the corrections there, there's a lot of them, 4 of them that show up there. But even if you waited for one of the second corrections, like you saw in 2003, and when the price of oil was sitting at $25, it still went up 5.9 times before the end of the cycle. That kind of a correction is what we're in now. When this is over, the bell's going to ring again, and we're going to see a fabulous upside in the sector. Now, every time it goes below 70, I say it's buy. Why? Because that's the break-even price. Just under $70 in the mid-60s is where the industry is at a break-even. This is from the Federal Reserve of Dallas. So whenever we've gone down to the mid-60s, it's been a buying opportunity, and that's what we've said to people, and we add more names to the buy list. As I said right now, we're sitting with 25 names on the buy list because we had some takeovers last year. If we add another 5, that's 30. 30 out of 37 names we cover on the buy list. That tells you we're pretty bullish. And that's what I think we're going to see happen. So if you look at the world demand, we are 102.1 million in 2023. OECD's 46.2, US 20.5, non-OECD 55.9, China's 15.8. By 2030, the OECD will be coming down, including the US. But where's the growth coming? Non-OECD. Those countries that will be providing the things we need to take our industrialization and our economies to the next level. And you're going to see China also growing 108 million barrels. So when we go into forecasting, you can see here we were up at $90 in the early part of 2020, or sorry, $130 when we had the invasion. We got up to $90, you can see in September of 2023. We got buy signals in March, and we added new names. We got buy signals in December. And our outlook is that we're going to be in a range between $65 on the downside, and we're 72 today. So we have, I think in the next few weeks, we're going to have one more decline, and that's going to give us another buy signal. And I'll walk you through the 3 that we're watching. But I think by sometime this quarter, we might be 82. Well, we were 78 on Monday, so that's not a big stretch. But by the end of the year, we're looking for $90 pricing on a regular basis and punching through 100 if there's any problems that happen in terms of the supply disruptions or anything on the political side that impacts the sector. And we think that is going to set the stage for even a better 2025. Now let's look at oil in terms of 2022 prices. If you look here, you can see 1980, that would have been an equivalent of 160 bucks. If you look at what it was in 2008, again, 170. So when we're saying we think we'll see all-time record nominal highs above 147, the high in the summer of 2008, based on just the historical data, that is not a stretch. And so we think we're going to see that happen going forward. Now let's talk about natural gas. The US has the biggest reserves after, and then Russia. And look at little Canada on the left-hand side there. We can be a bigger player, but we need to have the game plan to do it. There's massive LNG expansions coming on in the States. These are the approved ones, not the ones that Biden said, the next 10 projects have to wait and have to be reviewed again, i.e. the politics of left-wing politics in the States, where the climate activists are saying, stop everything, and they want to push it till after the US election. But look at the Southern USA. There's a lot of projects going on there. And if you look at Canada, we have a couple on the left side. So I'll show you that again. First thing is more on the US. They're going to add 6 BCF new capacity by 2025. And the US by 2027 will have 25 BCF. They are the largest exporter of LNG today, ahead of Australia and Qatar. And that number will get even bigger in the decade ahead. The one nice thing is we finally got the go ahead with LNG Canada, 90% complete. And it'll be ready to take gas sometime in the end of this year, early next year with the first shipments. And Woodfibre has also started to be constructed. So we finally got the go-ahead because we have the First Nations on side, BC governments on side, And the advantage of shipping from the West Coast of Canada to South Korea and Japan and China is much more economic than going through the Gulf Coast. And remember, the Panama Canal water levels are lower, so you can't fill ships as much. So the economic advantage is to us. And when you take into account that we only produce 17, 18, you add on top of that 6, 7 BCF, that's a pretty good growth rate. And that's why we are big fans of the natural gas market. So if you look here, natural gas prices, you see the jockeying that goes on there in the high lows. We think that we're going to see $7 gas sustainable basis probably by the end of the decade. Winter pricing, we've seen, as it was mentioned, by Chris from Birchcliff, we had 4 days at $10 gas, and now we're 2. So we're going to see, low prices here for a while. But the key thing is, with storage is coming down pretty sharply in the States. And if we have, in February historically is a pretty cold month. So if we can have 200-300 BCF drawdowns before the end of the drawdown season, we could end up in a very strong position. So over the next decade, I think the index is going to double. And as I told you earlier, the total return from the pipeline infrastructure will be the yield, 7-8%, 3% kind of dividend growth rate. That's going to be a nice total return. If you buy it right, you might get 5-10% capital gain. And then that's not bad for you relative to what you can get in the bank. The sexy stuff is going to come from the E&P sector and the energy service sector. And that's where we think the upside is. Now, remember, the SPTSX Energy Index has high weighting from Imperial and Suncor and Cenovus and CNQ. Those are the big weights. And if they're going to probably underperform from here because they can't grow as fast. But the companies that are in the 10, 20,000 BOE day range, 50,000 BOE day range, those guys can grow faster, and therefore they're going to outperform. So let's look at 2 models that we use for valuations. The first one is cash flow. Companies today are trading at 2 to 3 times what you could argue are depressed cash flow, given how cheap the commodity prices are. At market peaks, they traded 5 to 7, even 8 times cash flow at the peak. That's like a triple. Then you take into account the commodity is going to double. That gives you another double. So that's why we think these 5 baggers that we talk about are very, very likely given the situation that we're looking at. And as cash flows increase, companies will spend more money. As you heard from some of the companies earlier today, they have projects in front of them that they can grow when the economics are there, and they can bring them on and bring on lots more reserves. NAV, net asset values. Companies are trading today some below PDP, proved development producing, which is what banks lend against. Some are above it. But at the market peaks, they trade at the 2P NAV. And that's where the big upside comes, because you're going from PDP to, which is the proved developed, then you have proven non-producing, and then you have probable reserves. You all add that up, plus you take it, land, tax pools, and that's where you get the big bounce up. And plus you can add, as reserve values go up and commodity prices go up, people will add more production, which then means the reserves go up even further. So moving from defense multiples today, add in higher commodity prices into the end of the decade, higher production volumes, and again, talk to all the companies, ask them what they have in their inventory, ask them where they could take their companies in $90 oil and $80 oil and $100 oil, and you're going to hear pretty optimistic scenarios by those companies. And I believe, based on what we're seeing of underinvestment and what's going to happen with the emerging world, we're going to see much higher prices going into the end of the decade. Now, this presentation, a lot of people probably want some detail. Anyone who is a subscriber, you will be getting a copy of this by PDF next week. Now, let me talk about the 9 companies that are here today. 6 of the 9 companies that are here are companies that we cover and are on our SER buy list. So names you might be familiar with, names you like. Let me start with the first thing. In play today was $2.13. With the dividend, you're looking at an 8.5% yield. You're getting a monthly dividend there. 9,000 BOEs a day of production, and they're going to grow that production in 2024. The net asset value is $6.08 in our view at the end of 2022. So you can see that from, there's a triple just there on that miss of those numbers. You look at Hemisphere yielding, 7.5% now. Sarce Rock is yielding 9%. Surge Energy is yielding just under 8% at today's stock price. So you've got a lot of very big upside in the sector, and you can see how cheap they are. and the yield that's available today. And as these companies generate more cash flow, they will be able to increase their shareholder returns. If the stock's really cheap, they'll do NCIBs, or they'll give you special dividends. You may have heard Tourmaline says we're going to pay you our base and we're going to pay you special dividends every quarter. How much those are going to be, nobody knows based on commodity prices, but they are continuing to have the focus on shareholder returns. If we go to natural gas companies, we have 3 of them here, and you can see the yields on those. Birchcliff today is yielding 8.3. Petrus is yielding 9.8. Just taking account Birchcliff, when Chris was talking about his company and he talked about having 8 billion worth of reserves, almost a billion BOE equivalent. That in his book was $28. On my conservative side, where I don't include, where I use flat pricing versus the forward pricing that you see from reserve entity, that was $24.94. So if you can buy the stock under $5 and you got $24.94 as the NAV, which is going to rise over time, that is the value proposition in the sector. That's how cheap these stocks are. And if you don't believe me, go talk to the companies, ask them to show it to you. And in the case of a company like Birchcliff, they have an asset, which is Gordondale and Pouce Coupe, which is where you get that $24.94 from me and $28 from them. But that doesn't include the other big landmass they have called Elmworth, which could be just as valuable. That's not in the stocks. That's how cheap these things are. If you look at the energy companies, CES is a jewel. It's a company that provides the fluids for drilling and completions, and then for production. And the longer you reach the wells are, the more specialized the fluids are. They can get paid more money. The more they can help the producers to bring on production. They have the ability to grow it. $2 billion revenue company. You've got a bit of a dividend there, but it's a specialized company. Total Energy, it's got drilling rigs, it's got service rigs, it's got compression, it's got heavy equipment. It's involved in Canada, it's involved in the States, and it's involved in Australia. Worldwide company in areas where the basins are attractive, and you get a bit of a dividend. So, for people who have energy investments, how should you cover yourself and how should you get involved? Go over the company's presentations, and they update them every couple of months. Review the corporate releases, so have it on your watch list. Review the corporate financial and watch the outlook sections. Meet management when you can, here or at our Catch the Energy conference in Calgary. We have 42 companies last year. Well, I have 45 this year. And also watch the insider ownership. If they keep on buying their shares, that's got to be a signal to you. If they sell their shares, that's also a signal to you. And we've seen that in the past. So what we do at our place is we have something called a macro piece, which is called Ion Energy. Goes over the EIA data, natural gas, OPEC data, politics of oil, the macro forecasts, and it's a free publication, so you can just go to our website and sign up. Our paid product is the one that goes through this 37 companies. And the key thing is you have to take into account the global events, the fundamentals and technicals, the company research. That is what our team does to put them together to keep you up on the companies that you might own. We also have webinars. Once a quarter, we have webinars. And so our next one is going to be February 29th. And we're going to cover the Q4 results of the companies that are reported by that. Those that had good results, those that had poor results. We'll be very candid. We'll have a Q&A, 2 of them, and we'll go over that with people to go over what's going on. The one other thing we do is we have the Catch the Energy company. We had 35 E&P companies last year, and the TMX sponsored a critical mineral section and a clean tech section. And we had about 800 attendees signed up for it. The premier came and opened the conference. So they want you to invest in the sector. They want you to know that the government is friendly towards this sector. And so we think that we're going to try to up our ante this year in terms of it. We hope to get the premier back. And the final session of the day is going to be on LNG, because we're going to start having LNG being exported on the West Coast not long thereafter. So we will have companies involved in that. Lastly, with 50 seconds to go, Michael does an arm twist every year. And he said, Joseph, you guys do good work. You cover a lot of companies, but you got to do something special for my audience. Well, here's the arm twist. Well, firstly, the marketing piece. Oops. The balance of evidence is really critical. What's the good news? What's the bad news? What do we do in terms of our product? but the situation here is $100 off the annual subscription and the same on the quarterly. So if you want to get to know the product, the quarterly is the way to go. I think that we add a lot of value. You get one good idea a year out of it, it covers it. And many of you have seen the ideas and seen how the buy recommendations in March and December worked out. And so we hope come by our booth. And most importantly, please go and spend time with the companies. They're here for you. They want to have retail support. They want you to know their stories and they want you to own their stocks because they fit what you need for your portfolio investments. Thank you very much.